Okay, I am now recording the class. I will share my screen and start. Okay, can you see my screen now?
Yes, we can.
All right. So this week or today, we are going to be taking cost volume profit analysis. Now, it is a mixture of theoretical and some calculations, right? Theory and some calculations, but we're going to start with the theoretical aspects. I'm going to explain everything as much as I can, and after we understand it, we're going to take some questions at the end of the class. Is that fine?
Yes.
Yes.
Right. Okay, so let me see. First, let me just pick your brains a little bit or see where you are with this topic. So have you ever heard of the concept of cost volume profit analysis? Have you heard of that concept before, or have you come across it at one point? Maybe you've done an internship and you've heard about it, or maybe a topic in school or something. Do you have any idea what it is?
No.
Anyone? Okay. Okay. All right. So let's just go straight into it. So cost volume profit analysis. Now from the name, there is like a mixture of three different concepts or three different things: cost, volume, and profit. So I'm going to use the name to describe it. So you're basically it is basically an analysis that tries to find out the relationship between the cost of what you are selling, or the cost of your activities, and the volume of units that you sell, as well, and the profits that you make, because every business is set up to make profits, right? So profit is a function of your cost and your revenue, right? Your cost and your income, your costs and your sales. That's what makes up your profits. Profits is your sales minus your costs. So basically, you're trying to see the relationship between how much you are spending, how much you're getting, and the profits that you make. Are there decisions that you can make that will make your costs go lower, or decisions that will make your sales, your revenue increase in a bid to increase profits? Or you just want to check how safe you are as a business, whether your business is viable, whether there is a chance that your business will continue in the, like, foreseeable future. You just want to test how well, because as a business, if you're not making profits, why do you even exist, right? So you want to test whether profit is still viable for you as a business. That's another reason why we use cost volume profit analysis. So let me just go straight into it. Consider cost volume. CVP analysis, for short, is a management accounting tool that examines the relationship between three critical business elements: your costs, both fixed and variable costs, all kinds of costs. We're analyzing it here. Your volume, that is level of production or sales activity, as well as the profit, which is what you as a business exist to achieve. Simply, you can say CVP analysis helps managers to understand how changes in costs, selling prices, and production volume affect the company's profits. So if I sell more, will I make more profits? If I reduce the costs here, will I make more profits? Or if I change my selling price, would I increase my profits without affecting my demand and things like that? So CVP analysis assists with all of this. We go further to look at the purpose of CVP analysis. So CVP analysis answers important business questions like, how many units must we sell to cover our costs? What profit should we make at different sales level, right? How will a change in selling price affect our profits? So because there are times you might even look at historical records and say, if I increase my selling price, your demand will go lower. So you want to see whether it is like it makes sense for you to increase price when you know that your level of sales will be going down and things like that. What happens to profits if our cost increases or decreases? And should we expand production or introduce a new production line? So it is not only used by companies, that sometimes you might even have more than one product as a company or as a firm, right? So you want to test whether you want to test which of those products or which of those product lines produce the best profit, how their costs or how the volume in sales of each one, how your sales mix, that means how you mix products A and product B, gives you the best profit as a company. Now you can apply CVP analysis or managers apply CVP analysis to budgeting and planning. That means they use it to determine the required sales volume to achieve target profit. So at the beginning of every year, you might have a target profit. It might be a percentage increase from the one you had the previous year or something different. So you can use CVP analysis to analyze and determine the required sales volume that will hit that target. It is also used to calculate the safety cushion between expected sales and break-even sales. As we go further into the class, I'll explain what all these terms mean. Now, it also helps with pricing decisions. So CVP analysis will help you also to make the best pricing, to set the best prices for your goods, so that you don't pursue customers and you still make enough profits to cover your cost, enough sales to cover your costs and make profits. Now, it also helps in deciding which products to emphasize in multi-product businesses and to determine the optimal combination of products to maximize profit. So there are some products that might not really be profit generating, but without selling them, you might not be able to sell the others. So CVP analysis helps you to determine the appropriate or the right product mix. Then it helps choosing between high fixed cost or labor intensive cost variable type of production, right? And it helps you to evaluate investment decisions that change the cost structure. Now, before we go further, does anybody have any questions so far?
No.
Okay. Do you understand everything I have said? Can I continue?
Yes, you can.
Yes.
Okay. So now there is an important concept when talking about CVP analysis. In fact, it is like the debit and credit of CVP analysis. You need to understand it. It is called contribution. Right? When you talk about when you as a business owner, say you have a small business, if somebody asks you what's your profit, you just tell the person, oh, in a year I make profit of this amount. And how do you arrive at that? You probably tell them the amount you get after deducting your total cost, your cost of rent, your cost of buying the goods, your cost of payment for advertisements and things like that. If you even pay salary, you add everything, you add all those costs, and then you deduct it from your what I call it, from your sales to arrive at the profit. And then the person is now like, is that profit enough for you? And then you just go ahead and say, I might increase my selling price and stuff. Now the thing is, you are using profit to make all these decisions, but then there are some costs that you cannot necessarily manipulate them. Remember, I don't, if you have, you must have you must have at least read the notes or revisited the classes, or maybe you were even in the class where we talked about cost classifications according to behavior. So fixed and variable costs differ in the way you can use them. You cannot necessarily control some costs, like fixed costs, right? You can't control them. So you cannot really control how, maybe you want to, unless you want to move to a different location, which will mean looking for new customers and everything. You cannot really control how rent affects your profits. So that's why cost accountants now, they came together and they derived something called contribution. It's a concept. So contribution is basically your sales minus your variable costs. The idea behind it is that your fixed costs are not really important. Like, or should I say, no, they're not necessarily important when it comes to decision making like that, because you can't change them, you incur them no matter what, right? It is your variable cost you can manipulate during the year. You can change it how you want to fit what you make at the end of the year. So your contribution, they called something called, they derived a concept called contribution towards fixed costs. So after deducting all your variable expenses, that means those costs that are direct to how you sell or how you produce goods and everything. All of course, after you deduct them from your sales, anything that is left is what you can use to cover those fixed costs, what you can contribute towards those fixed costs. So anything that is now left after that is what you have as your profits. Do you understand? So your contribution it is one of the most important concepts in CVP analysis. It represents the amount of money remaining from sales revenue after deducting variable cost. This remaining amount contributes towards covering fixed costs and generating profits. So your contribution is like what you use to make decisions. It is what you use to know whether your company is doing well or not. How much are my fixed costs in a year? So in a year, whether I sell or not, whether I produce or not, whether I offer services or not, I am going to spend this fixed amount, right? So how do I make sure that I contribute enough towards those fixed costs? That's what the concept of contribution deals with. Do you understand? Can we move further?
Yes.
Okay. Please draw me back at any time if you have a question. Now, why is contribution important? They say you should think of contribution as the building block of profit. When you sell one unit, you receive the selling price. From this, you must first pay the variable cost associated with that unit. What remains is now what you can contribute towards fixed costs. So once all fixed costs are covered, any additional contribution becomes profit. This is all I have explained before. So when this is even more important when you are thinking about when you have more than one different product or more than one line of sales that you have. So if you rent a shop for 3 different products A, B, and C, you rent a shop for them, you use the same, maybe you use the same refrigerator for them, you pay the same running costs like service charges for all of them, right? But each of them have their own differing variable costs. So after selling each of them and deducting all their variable costs, you'll be able to analyze what each of them contributes towards paying for that joint fixed cost. So it's that time okay, product A is contributing more. Let me sell more of product A. Product B is not really doing anything. Let me discontinue this one or reduce how I sell it. Do you understand? So that's why contribution is important. Then you now have the concept of the contribution margin ratio. So your contribution margin ratio or profit volume ratio, it shows the percentage of each sales naira, what percentage of each sales naira becomes contribution. It's easier to understand using mathematical formula. Contribution per unit divided by selling price per unit, or times 100%, or total contribution divided by total sales times 100. So it is like what percentage of your selling price or what percentage of your sales is contribution, right? So if you make sales, you make revenue of 400,000. How much of that 400,000 is contributing towards fixed costs? Maybe after selling, you bought the goods at 300,000 in total, right? And you sold them for 400,000. It means what you have left is 100,000 to contribute towards fixed costs. Do you understand? So it is not yet profit until you deduct fixed costs. So maybe your fixed cost is now like 50,000. That means your profit at the end of the year is 50,000. That's what you take home. That's what you can tell people that, okay, my profit is doing well or not. Now, let's look at some examples. We're just going to walk through them. As I said, we are going to take examples at the end of the class. Let's just walk through these ones. Now, ABC company sells a product for 500 naira per unit with variable cost of 300 naira per unit. So you can see contribution per unit here is 200 naira. So that means it is that 200 naira now that you have to contribute towards fixed cost for each unit. Know the difference. There is contribution per unit and there is contribution margin. Contribution per unit is which, like for each unit, how much is each unit contributing? But contribution margin is in total. So when you multiply your contribution per unit by the total contribution, by the total unit you get your total contribution or your contribution margin. So look at this. They say if they sell 10 units, your total contribution will be 2,000 naira. So this 2,000 naira is available to cover fixed costs. So assuming fixed costs are 1,500 naira, that means your profit will be 500 naira. Do you understand? Hi. Can you still hear me? Do you understand?
Yes, yes, we can.
Yes.
All right. Okay. Now let's take looking at another example. Using the contribution to sales ratio or contribution margin ratio. Here you consider a product, selling price is 100 naira per unit, your variable cost is 60 naira per unit, and your contribution per unit is 40 naira, right? So then what I was explaining the other time is that what percentage of your selling price, so now out of that selling price 100 naira, it is only 40 naira you can contribute towards fixed costs. Do you understand? Now, the interpretation of this is that for every 100 naira in sales, 40 naira contributes towards fixed costs. Okay, then we can looking at the, okay, sorry. Sorry, what did you say?
Please, can you go back? Can you go back?
Okay. Are you
Yes,
taking
yes,
screenshots? I'll share the notes with you.
yes, please, can you explain again the contribution per unit?
Okay. Contribution. Is it
Thank
contribution
you.
or contribution to sales ratio?
From contribution per unit.
Okay. So for a single
Thank you.
product, you sell it at 500 naira per unit, and each of those products, each unit costs 300 naira. So you buy it for 300 naira and you sell it for 500 naira. Normally, in a layman term, you will say that 200 naira is profit, but no, that 100 naira is not your profit. It is just what each unit contributes towards your fixed costs. So, as I explained earlier, there is a difference between total contribution and listen, there's a difference between total contribution and contribution per unit. When you say contribution per unit, you're looking at it from each unit that you sell. But total contribution is now everything that you sell to get multiplied by your contribution per unit. So if one unit contributes 200 naira, how much does 10 units contribute? I'm asking you now. Are you with me?
Yeah,
Yes,
2,000.
please.
2,000. Yes. So if one unit contributes 200 naira, that means 10 units will contribute 2,000. So your total contribution now as a business at the end of that year is 2,000 naira. That is what you have to pay for fixed cost. That's what you have to contribute towards fixed cost. So it is after deducting your fixed cost, whatever the amount is. In our example here, we are told that fixed cost is 1,500 naira. It is after deducting that 1,500 naira that you get your actual profits, which is 500 naira. Is that clear, or should I go back? Is there something you want me to?
It's
What did you say?
clear now.
All right. Okay. So here, this is a table now that illustrates everything simply. So it shows the work from sales to profits. So you have sales of 50,000. You deduct your total variable cost of 30,000. You have your contribution of 20,000. And then after you deduct your fixed cost, you have your profit. So this table is like a summary of the journey from sales to profit, how you pass contribution and get to profit. Okay. So I'm going to move forward now. Now, this leads us to break-even analysis. I'm sure that sometimes you would have heard that some people even just refer to CVP analysis as break-even analysis. And they'll be right, because break-even analysis is basically like a, should I say, yes, a narrow version of cost volume profits analysis, right? So, okay, yes, you're analyzing how your cost and your volume affect your profits. But another thing that CVP analysis does, as I mentioned earlier, is that it helps to see how safe you are as a business. Are you making profits? How far away are you from making a loss? So all these things are things that you should consider. So that's what break-even analysis, BEP analysis, now helps us to analyze. So let's look at it. Now, a break-even point is level of sales in units or naira. That means it could be when I sell 40,000 units, I break even. Or it could be when I make sales of 800,000 naira, I break even. Do you understand? So it could be in units, or it could be in like a naira value. It could be the total amount you sell. So you can say I made 1 million naira sales. That was when I broke even. So it means that I'll explain further anyway. Or it could also be that you said I sold 50,000 units. So it could be in units or naira. It is the level of sales at which a business makes neither profit or loss. At this point, total revenue is equal to total cost. So what this means now is, let's go back to that table that shows the journey from sales to from sales to profit. So assuming your profit here is zero, that's what break even means. Your profit here is zero. It is not a negative figure. It is zero. So what must have happened for that to happen? It means when you deducted your variable costs, arrived at your contribution, and then deducted your fixed costs, you got zero. I want you to know that it does not mean your contribution is zero, it means your profit is zero. Profit is different from contribution. You get profit after you deduct fixed cost from contribution. Do you understand? So they said it is the point where there is neither profit or loss, nor loss. So after deducting your total cost, both your fixed and your variable from your revenue, get your break even. I'm sorry, you get zero. That's what break even means. See? So it could be total revenue is equal to total cost, or total contribution is equal to total fixed cost. So meaning, let's use this table for instance. After deducting variable cost of 30,000, you get contribution of 20,000. If your fixed cost is also 20,000, that means your profit will be zero. Do you understand? So it could be that you can say it is where my contribution and my fixed cost is the same thing, because when you deduct it will give you zero. Or you can just say it is when your total cost, that means both your fixed and variable, is equal to your revenue. So you have two formulas for it, for your break-even points. Sorry, to get break-even points. Either total revenue is equal to total cost, or total contribution is equal to total fixed cost. Do you understand that?
Yes.
All right.
Yes.
Okay. So at break-even point, the business has sold just enough units so that the total contribution exactly equals the fixed cost. So you are contributing exactly what you need for your fixed cost. You are not making a profit, you're not making a sales. You just want to make sure that at least you're not owing anybody, you paid everything. Do you understand? Now, break-even analysis helps business to understand the minimum sales required to avoid losses. So yes, you are trying to target profits. But before you even get to that, especially for a new business, you want to even try to not make losses, right? Because you would have bought a lot, you would have borrowed from some people and everything. So you want to make sure that at the end of the day, when you pay back, or when you pay for everything that all the expenses that you incurred, you are still you are not owing anybody anything. That's what break-even analysis helps to do. It also helps to understand the risk level of a business venture, right? So you want to know how risky your business is, because it is little by little. By the time you start making losses, it leads to a thing where you are not liquid again, you become bankrupt, and you have to close up the business. Do you understand? Then it also helps you to understand when a new product will become profitable. Do you understand? So maybe you have done your analysis and you understand, okay, if I break even at this point, by this year, maybe I would have gotten more customers, my sales will go up, I'll be able to make profit. So it helps you to understand all of this. It also helps to understand the safety margin between current sales and danger zone. So maybe you're even making profits at the end of the day. Like maybe you might be making profits, but then break-even analysis, by the time you understand, maybe your break-even point is when you sell 1 million naira. If you are selling 1,200,000 naira, it means that you are very 200,000. It means you are very close to that break-even. You are very close to making a loss. Yes, you are making a profit right now, but it's you see break-even analysis will help you to understand that, oh, you must not go below what you're currently selling, or you must try to sell more so that you not enter that danger zone that you start making red balances. Now, when you want to calculate your break-even points, there are two basic approaches, two mathematical approach used for calculating the break-even points. The first one is the equation approach, and the second one is the contribution margin approach. Now, for the equation approach, it's very simple. You use the basic profit equation. Sales is equal to variable cost. Sorry. Yeah, at break-even point, you've already said your sales is equal to your total cost, right? And then total cost can be broken down into fixed cost and variable cost. So at break-even point, your sales is equal to variable cost plus fixed cost. These are formulas. The key to understanding this topic
Please,
as a yeah.
please, ma, you are too fast, ma. Please, small, small.
Okay. Okay. So
Yes.
I'll try to slow down. Thank you. Okay, so the key to understanding this topic as a whole in total is just understanding these formulas. If you understand, and the most important formula is the profit function, basically. So everybody knows that profit is equal to your sales minus total cost, right? So when you want to understand, as I mentioned earlier, break-even point is where your sales is equal to your total cost. Do you get? So when you're So when you want to use the equation approach, your break-even point is where sales is equal to total cost, or where sales is equal to variable cost plus fixed cost. So just know all these formulas, because when we get into it, we'll start using them one by one. When we want to apply it, you understand it better. You can also use the contribution margin approach. I explained what contribution margin means earlier, right? I explained it. Now, I said it is what percentage of your sales or your selling price is contribution. So if you sell 100,000 naira, how much inside 100,000 naira are you contributing towards fixed cost, right? What percentage of it? That's what your contribution margin means. That's what your contribution margin approach means. So if you want to use it to get your break-even points. Now, break-even points, that's another thing. When I started explaining break-even points, I said it is in two, like it is in two forms. You can either talk about it in units, or you talk about it as sales that you make. So you can say it is the number of units that you sold where you made no profit or loss, or it is the amount of sales. So you can say it is, I sold 40,000 units and I broke even, right? Or you can say I made sales of 1 million naira and I broke even. But you're either talking in units or you're talking in naira. So we call them BEP units and BEP sales. BEP units and BEP sales. So there are two, should I say, forms of BEP. So it could be BEP sales and BEP units. You should pay attention to this because the questions can come in any of those forms. Now, when you want to find BEP in units, that's break-even point in units, the formula is fixed cost divided by contribution per unit. Let me explain. So remember, I told you when you look at this, when we are talking about break-even points, we said it is where total contribution is equal to total fixed cost, right? So imagine you are not giving your contribution. They don't tell you what your contribution is, but they gave you your fixed costs and they said it is at break-even. So maybe they told you when you at break-even point, your fixed cost was 200,000. It means at break-even, your contribution was also 200,000, because from the formula here, we are told that total contribution is equal to total fixed cost. They are the same at that point. When you deduct fixed cost from contribution, you get zero. So anything they give you as your fixed cost, it is also your contribution. Do you understand? So that's what that's what the formula is telling you basically. So coming back to this place, they now said BEP in units. So if you want to get how many units now that you sell to break even, and you are giving your fixed costs and your contribution per unit, when I'm sure that all of this will seem confusing now theoretically, but when we start to do examples, you understand it better, and I'll explain further there. Now you have BEP units and BEP naira. So the formula, just note down all these formulas. For BEP units, the formula is fixed cost divided by contribution per unit. For break-even points in naira, your formula is BEP naira is equal to fixed cost divided by contribution to sales ratio or contribution margin ratio. Just note down all these formulas. When we want to do calculations, I will explain even further. Now, another concept we talked about what CVP analysis means. We talked about the concept of contribution and why it's important. We talked about break-even analysis, what break-even point is and why we analyze it. And now we want to talk about target profit analysis. All of these are important concepts under CVP analysis. Okay, let me see. Let's take a quick. I want to see who is taking notes and who is not, or whether you people are following me. So let me start with Oluwayemi Taiwo. Can you hear me? Good afternoon.
Yes, ma'am.
All right. So can you give me, in your own language, in your own words, can you just give us a brief description of what contribution means?
Though I joined late, but contribution can be the amount of money that is put into a business.
Okay, you see, This is why it's not good to join late. Make sure you go over the recorded parts. Okay. Okay, can let me see. Miriam, you were here at the beginning. Can you help her? Let's see. Explain it to her as somebody that was in class from beginning. Miriam, can you hear me?
Yes. Hello?
Yes, I can hear you. Okay, go ahead.
Okay. I said from the explanation you give, you suggested that there is a difference between contribution per unit and how contribution is like a margin. Mm, is like profits, yeah, like profits too. And then that's what I understand. Like
Okay, you said it is like profit. How is it different from profit? Why is it not profit?
that's the layman thing. Hello?
Hello, yeah, I can hear you.
Because you're subtracting the sales from cost.
Hmm. Okay. I think people were saying you understood. Okay. Let me see. Abida, can you let me hear your own opinion or what you understand, your own understanding of contribution.
I'm just joining the class. I don't know.
Okay. Aliyah, hi.
Hi, ma'am.
Good afternoon.
Good afternoon,
Okay, so what's your understanding of con-
ma'am. My understanding of contribution. Now, can you hear me?
Yes, I can hear you. I can hear you.
Okay. Contribution is the additional units on at every extra point of production that and is quite different from profit because it is measured at like every point, not the same total difference between cost and sales of that particular product.
Okay, I actually lost you at one point. Your this not very
Ma, can you hear me now?
yes, it is way better.
Okay, I said contribution is the additional unit or naira at every point of production. Now, it also depicts sales minus the cost involved, but it is quite different from profits because it is measured at every point and not the sum total.
You are using one textbook definition. I need you to explain it in a way that everybody will understand. Like, okay, I want to know how you understand it. I don't want to know what you jotted down. Do you understand? So let's I want you to explain it in layman terms. Or imagine you're talking to your mom now that owns a small business and you want to let her know that okay, this my contribution is not your profit. So how will you explain it to her?
I don't know.
Okay. Okay. Let me see. Kemi, good afternoon.
Good afternoon,
Can
ma'am.
okay, good afternoon. Okay, so let me hear your
Yes,
own
I can.
understanding.
I joined the class late too, so I just have the questions here on my notes. I didn't really get that from the starting.
And all of you were saying, I understand, I understand. Okay. What about Oyinye?
Only subject.
Yeah, absolutely.
Good afternoon. You were here at the beginning of the class, right?
Yeah.
Okay, so what do you understand by contribution?
Okay, in my little understanding about the contribution, I I think it's the amount that you get after deducting variable costs.
So the amount you get is the contribution, and from that contribution, you now remove your fixed cost to get your main profit. I think
Thank you very
that's what.
much. Thank you. Thank you so much. Okay, so that's basically it. But let me take it again. Let me just re-explain. Let me use an example. So, as I said, when I was talking to Aliyah, then I said she should explain it like she's explaining it to some one market woman that has a small business. So let me explain it to you like that. So I come to you now and I say, what is your profit? Right? What you tell me is probably yes, what you tell me is, so let's assume the person sells pure water. I don't say you sell pure water now because if people start saying God forbid. So let's assume the person sells pure water, right? And I go and meet the person, Madam, what do you make as profit? The person will tell me, I buy pure water. I bought 10 bags at 3,000 naira and I sold them 4,000 naira. So my profit is 1,000 naira. So this person now is not telling me profit. The person is telling me contribution. Why? Because that person has only calculated the cost of buying her products and how much she sold them. She's not talking about the rent she's paying. She's not talking about the light. She's not talking about cost of, maybe she's even renting freezer herself. She's not talking about that. She's not talking about how much she spends when she wants to advertise people, come and buy you, things like that. She's not talking about all of these costs, right? She's only talking about how much she bought it and how much she's selling it. You get? So what she's telling me is contribution. She's contributing that 1,000 naira towards. Now I'm sure this is the way. I'm sure all of you are even aware that this is how most of these market women operate. What they do is they have their, like, should I say, target at the end of the year. Oh, I need 100,000. I will use 80,000 to pay for rent. I'll pay 10,000 naira for light. I'll pay this one. So I didn't. They're probably even doing ajo, right? So think of it as ajo. So it's even the English name of ajo said contribution, right? So every day after I sell, how much am I contributing towards, how much ajo am I making towards that fixed cost that I'll pay at the end of the year? That's basically what contribution is. So it's like, think of it like ajo. Think of it that every time you sell and you deduct your purchases from your sales, right? After you deduct your purchase from your sales, what is remaining with you is what you want to use and pay for all those other costs that you don't normally think about when you're explaining your profit to people. All those rent, lights, things like that. Think of contribution like that. So contribution, as I mentioned, think of it as ajo. So how much am I making? How much am I saving towards them? So it is after you have now deducted all those other costs. Maybe at the end of the year now, this woman now make like 120,000. She was able to save 120,000, or she was able to contribute 120,000, and she now deducted all those expenses 100,000. So her profit now is 20,000. Do you understand me now? Is that a clearer explanation?
Yes, ma. Ma, I have a question, ma.
Please go ahead.
Ma, can we also see contribution in the aspect of gross profit under trading profit and loss?
Hmm.
I mean, can we see it in that same view?
Yeah, I'll say yes. I might say yes, but then no, it's not like that, because in cost accounting, we like to think of cost in relation to behavior, right? We like to think of we like to do marginal costing. So here now we are not thinking of gross profit and net profit, because let's assume that you're thinking of it as this thing, I'm calling it net profit. You know that when you're doing your trading profit and loss account, what you call your this thing, you have your sales, right? But then you have your other incomes, Abby. You have other incomes. Those other
Mm-hmm.
incomes, where do you treat them? You treat them in your profit and loss, not in trading accounts, right? When you're doing cost
Yes,
accounting,
ma'am.
you don't think about it like that. Every time, as long as you are making it in business, you think about it together. Do you understand? Or even your costs.
Yes,
There are some costs like variable. There are some variable costs that they are not necessarily related to production. Like maybe you have somebody, a salesperson, and that person, you pay the person based on commission, right? So you say, this is so every day
ma'am.
as that person comes, maybe you have the hair like those women that sell pure water now. You know, they have those people that will come and hawk the pure water for them and everything. So maybe at the end of the day, they have to pay those people each price. So every day now they deduct that one too before they calculate what they call profits. But to you, you know that it is contribution. So all those things now, they are not necessarily purchases, but they also make sense. So if you are thinking of it from the financial accounting, all those come in this. They will come under net profit. They'll come under other expenses. They won't form your part. This and what you call your trading account. So no, there are two different terms. Do you understand? In cost accounting,
Yes,
we take
ma'am. Thank you, ma'am.
fixed and variable cost. You are welcome. We are going to take a very comprehensive example at the end of the class, and we are going to break all these things down. But I just want to know you get the concept. So Miriam, Oluwayemi, everybody that joined late and those that joined early but we're not able to understand very well. Do you understand now? Or do you have any question?
Yes, ma'am. Ma, I want to say, can we say that contribution is that profit, the profit of maybe anything that you are selling before fixed costs are deducted?
Yes, you can use that, but I don't want you to be using profits. Don't use profits. Call it contribution. You get. So yes, you can
Okay.
that's basically what it is. You can say yes, it is profit before deducting fixed cost. You can call it that too. Profit before deducting fixed cost. So after you get your final profit. So yes, you can think of it that way, but don't go and write profit before deducting fixed cost in your exam.
So
Call it
how am I going to ask it?
you just call it the amount. Say it is the amount that you
Okay,
get.
okay.
Yes, that is
The amount
left.
of a product before fixed costs are deducted.
Exactly. So the amount that you get after deducting your variable cost from sales that is left to contribute towards fixed cost. You can call it like, you can explain it like that. So you don't have to use profits.
Okay, thank you.
You're welcome. So does anybody else have any question before we continue? Okay. So I will take your silence as no. Can you still see my screen?
Yes, my boy, small. Yes, ma'am.
Sorry about that. We'll soon move to a bigger screen now. I want to take listen. So where did I stop? Have I talked about target profits?
No, you're just about to explain that.
All right. So let's talk about target profits. Now we've been talking about break-even points since we said break-even points is okay. I only asked you questions based on contribution. Should I ask you questions on break-even points, or you understand that one?
I understand.
Somebody said I should ask how. Let me ask. Who is that person that said I should ask?
Yeah,
Who is
me.
the person? Okay, Yemi. What is break-even point?
Break-even point is a situation when there's no profit or loss. No loss.
Yes, exactly. So where there is no profit, no loss. So how does it happen that there is no profit or loss?
Maybe when the amount that your income, the income of the business is
Yes.
equivalent to the total cost, the amount that you used in getting everything that makes the business move.
Yes.
So when they are equal,
Yeah.
that you are almost close to not making any profit.
Yes. So you're not making
Yes.
you're not making loss. They're equal to each
Yes.
other. Yes. That's a break-even point. Okay.
Yes.
Thank you very much. Thank you. So
Yes. Thank you.
now target profit. So when you're talking about break-even points, you're talking about where profit or loss is zero. Happy? But when you now think of target profit, this is where you actually give an amount, or you actually give a figure to profit. So as I mentioned earlier, when I was talking about how businesses use CVP analysis for budgets, is because they want, like at the beginning of a period, they might say something like, this period we're going to make listen, this period we're going to make 7,000 naira in profit, or this period we're going to make 7 million naira in profit, depending on how big the company is, right? So that amount that they are trying to work towards, that amount that they want to make sure that after I deduct my cost from my sales and I pay for everything, I have this amount. That is your target profit. That's what target profit is. So you can, just like break-even points, you can think about it in two ways. You can either say how many units do I have to sell to make this target profits? Or how much sales should I make to make this target profit? So you can say, should I sell, I'm going to sell 50,000 units if I want to make profit of 1 million naira. Or you can say, I'm going to make sales of 5 million naira if I want to make profit of 1 million naira. So you can say it in two ways. So target profits is basically, okay, looking at this, they said often businesses don't just want to break even. So as I mentioned earlier, it is only new businesses or businesses that probably they were going through something bad before that will say, oh, let's even manage to break even. Let's even manage to not make loss. But when a business is doing well, when a business is growing, you're thinking about profits. If this year I made 200,000, I might say I want to make 100% more profits next year. So I want to make 400,000 the following year. How do you plan around that? How do you make that? So they want to achieve a specific profit target. CVP analysis helps determine the sales level needed. So I need you to write down these formulas as well. I'm going to be asking you for the formulas when we are doing our calculations. So I want all of you to remember them. Please write them down. So for target profits in units, it is required sales units is equal to fixed cost plus target profit divided by contribution per unit. I'm going to explain why each of these formulas are like this later, but just know the formulas for now. Now, you now have, sometimes your examiner might now want to be wicked, or they might want to do exactly. Now, thinking about how Nigeria is now, so that everybody has to pay tax, right? So imagine as a business, you pay a certain percentage as tax. So you might now say, or let's not even use official tax now. Maybe market women now that pay a certain amount at the end of the year to, well, it's actually tax too, but they are unofficial mostly. So they pay a certain amount every year as tax to some people that will just come, oh yeah, mama, 5,000 new way. So basically, when you want to think about it as, this woman will now sit down and say, I want to do it in a way that even after I pay that 5,000 tax, I still want to have this amount as my profit. So sometimes your examiner might want to test you. They might want to know whether you can work with tax too. They might want to know whether, okay, if a business owner or as a cost accountant, your business is saying want to make 200,000 naira profit after paying tax to the government, and everybody knows the percentage, or you be giving the percentage that you pay as tax. So I said, after paying this amount as tax to the government, I still want to have this amount. So sometimes you might need to work. So you have to work backwards to it. First, you have to derive what your profit before taxes. You know, what we have been explaining before now is profit before tax. Everything we have been talking about is profit before tax. Right? So we're not talking about tax. But then what if this one, I'll tell you, your examiner will tell you, okay, you want to make profit after tax of this amount. So you first have to add back that tax, get your profit before tax, and then you now find out how to get it. So we are going to talk about all of this when we are solving a question. You understand better with a question. But I need you to just get down all these formulas. I hope we are writing. I hope we are with our pens and books. I need you to write down all these formulas. All right. Now, okay. Now, another concept in CVP analysis is margin of safety. Remember, I told you that time when I was talking of break-even point, I said sometimes the reason why you want to know your break-even point is because you want to know how safe you are as a business from making loss, right? So, okay, I'm currently making profit of 200,000, but that means it's only 200,000 I'm making now. How much do I have to sell more so that I'll be very far? Because that 200,000 is shaky. By the time government will come, collect this percentage, something might happen. Maybe a lawsuit will come, you pay this won't happen, you pay this. The profit has finished. At the end of the day, you know, you already start making loss. So you should be thinking, as a business, you should be thinking about how to run far away from that break-even point that it now leads to loss. You should be thinking about how you should be very far away from it. So margin of safety represents the cushion or buffer between actual or budgeted sales and break-even sales. So it shows how much sales can drop before the business starts making losses. So if currently now you're selling 5,000 units, and from that 5,000 units, you're selling or you're making profit of, let me say, 500,000. When you sell 5,000 units, you make profit of 500,000. So what this is telling you is that if my sales drop to 4,000, how much profit will I make? If it drops to 3,000 units, how much profit will I make? Like, what if it is when what if is when you sell like maybe 2,500? You were selling 5,000 units before. Maybe it's when you sell 2,500 units that you start making a loss. So like you need to, all these things you need to calculate. That's what margin of safety helps you to calculate. So it helps you to know, oh, I should not, my sales should not go below this level, or my selling price should not go below this level. I must keep it up at this, because anything can happen, right? You should be making measures, making amends. So management might ask you as a cost accountant that help us to analyze how far we are away from making a loss. What do we need to do, right? How many units should we make sure that we always sell if we want to keep on making profits as we are currently making profits? That's what margin of safety is. So it just like every other concept, it also has its own formula. And the formula is actually very simple. Budgeted sales minus break-even sales. When we get to an example, as I've been saying, you will understand better. But that's the concept. So the concept is basically, am I safe? Do I like what how far away am I? Yes, use that. How far away are you from making a loss? How safe are you from making a loss? How safe are you from danger zone? Because loss is danger zone. So you want to know how much these profits that I am making, is it something that I can call a blanket? Is it something that, okay, I'm still, maybe if imagine when Corona happened, a lot of businesses suffered because yes, they're making profits, but they were not really thinking, what if something happens and people cannot come out and buy something? What if something happens and people are on lockdown? Will I still be able to meet my customers? They don't think about that. So when things like that happen, so you should always be thinking about this, that how safe are you? So that if a catastrophe even happens tomorrow, that even if you don't make profits like that, you'll still be able to come out unscathed. That's what margin of safety helps you to analyze. Now, look at this, interpreting margin of safety. We say a high margin of safety means that the business is well above break even. There is a comfortable buffer between loss before losses occur, and the business is less risky. So it means that you are very far away from making loss. That even if something bad happens, maybe a lawsuit comes and you say, they saw cockroach in the water that you sold to them, and you have to pay lawyers and everything, because it's not something that is an everyday expense. So it's not something you necessarily calculate for. But what if something like that happens, or the business even burns down, right? Like, how much will you have to spend that by the time you spend everything, you restart your business, after you collect your insurance, you restart business and everything? Will you still be safe? Will you still be able to say, oh, I'm not making losses, or you will not make too much loss? That's what margin of safety helps you to calculate. So if your margin of safety is high, that's it. You need having a high margin of safety is very good. When you have a high margin of safety, it means that if something even happens, or if your selling this thing goes down, like for instance, now take businesses that they already calculate that, okay, my business makes more money in Hamatan, and then Hamatan did not come. What will you do? So if they were not making a high profit before, when they already budgeted that when Hamatan comes, we'll make our profit and everything, they will suffer a very big loss. But if they were already taking measures, maybe selling other products and trying to keep their profit level in a safe area, a safe zone, they will not have too much problems. Now, a low margin of safety means that a business close to break even, a small drop in sales could lead to losses, and business is more risky. So when your margin of safety is low, it means that even if you are making profits right now, if any small thing should happen and customers maybe just shift and did not buy your product a little bit, you will make a loss, and next thing, your business is at the risk of suffering bankruptcy. So that's what margin from the name safety is. You're thinking, okay, how much am I selling now, and how safe am I from making loss or from entering danger zone? Now, there are some assumptions in CVP analysis. They are not necessarily, should I say, realistic. It's not every business that operates like this, but just like every other concept, or like a lot of concepts in cost accounting, like EOQ, for example, now, we also have assumptions here that, like, you have to, should I say, assume, or you have to take into consideration when you are using CVP analysis. So you should bear in mind that even if you are using CVP analysis to be cautious, right, you should know that there are some things that you cannot control, that are beyond your control, and that don't fall into the assumptions of CVP analysis. So one, under CVP analysis, we believe that costs can be clearly separated into fixed and variable components. And it's not always true, especially for places like service industries. You might not necessarily be able to separate what your fixed cost is and what your variable cost, because there are some costs that will look like they are variable, but they might actually be fixed. And there are some that will look like they are fixed that might be variable. So in practice, really, it is not very easy to separate fixed and variable costs. Then 2, we also say fixed costs remain constant throughout the relevant range of activity. In our previous class, when we are talking about classification of costs according to behavior, we talked about something called stepped fixed costs. That, okay, in a given range, maybe I rent a class now to teach people and it can take 100 students. What if I now have 101 students and I don't want you people to lap? That means my fixed cost will increase, right? But when it was just 100 and less than 100, I was saying it is fixed because even if I take 10, 20, 30, 40, I'm still paying the same amount as rent. So I was saying my rent is fixed. But what if they now exceed the range that class can take? What will happen then? Do you understand? So in CVP analysis now, we assume that fixed costs remain constant, which is not true because there are times that it might exceed that range. You might need to rent an extra machine, or you might need to pay extra for rent or warehouse and things like that. Now, another assumption is that variable costs change proportionally with volume. So it means that it is based on the definition of variable cost anyway. Another assumption is that variable costs will remain the same in units. So if whether I'm buying 10 units or I'm buying 20,000 or 10,000, 30,000 units, I am paying the same amount per unit for variable cost. Another one is that selling price per unit. Although these ones, there are times when your question will ask you to change them. So we'll look at these ones as we go. And yes, another thing is that there is no quantity discount or price discrimination. And it is not true. Because there are times that your variable cost, you might say your cost of purchase is like 100,000, but what if the supplier gives you discount? Once you take it into accounts, like, you know, that your formulas will start changing by the time you start saying, let me put this. So CVP analysis, for simplicity said, let's just assume that there are no discounts. Then production volume equals sales volume. Yes. So here in CVP analysis now, if you realize, we've not talked about anything called inventory, maybe opening or closing inventory. And it's not true. In reality, you have opening inventory, you have closing. You don't sell everything that you buy during the period. Sales is not equal to production, right? You don't sell everything that you produced or you sold or you bought during the year. Now, another assumption is that in multi-product firms, the sales mix remain constant. So remember, I said it is not only applied by companies where you are selling one product. Sometimes you might be selling 3 products. So the assumption here is that if you're selling 3 products, if it is 10, 10, 10 you're selling, it's only that 10, 10, 10. If it is 10, 15, 20 that you mix them, that's it. So it assumes that the product mix is constant, and that's not true in real life. Then we also say productivity and efficiency remains unchanged, which is not true, because if the fact that your machine can produce 10 today does not mean it's produce 10 tomorrow. The fact that a human can do something well today does not mean they'll do it well tomorrow, or they might even be doing it better the next day. So it is not really something that can be really reliably measured. Then another thing is that technology and production methods remain constant. This is also not true. Well, not in all cases anyway. And then that the relevance range assumption holds and general price level remains stable, no inflation or deflation, which is very, very untrue in Nigeria. So that's one thing. Most of these assumptions are just there to make the formulas flow smoothly, to make us be able to calculate very well, because mathematics works with formulas and assumptions and everything. But in theory, they might not be true. Just want you to know that. But know these assumptions very well. Now, okay, because of time's sake, I'll not be going over the important It helps management to make decisions. Should I launch a new product? Should I expand my operation? Should I change my production method? All these things, you would understand it better when you use CVP analysis. CVP analysis also helps to analyze risk. So things like margin of safety, like target profit, like BEP, you use them when you want to know how sensitive your profits are to changes in volume. What will happen if one big loss occur? Will I still be safe? How risky is the business? It helps you to know. It also helps with planning, with budgeting, with cost control. And then we also there are some places that you get data for CVP analysis. So it might be from your budget, might be from your standard costing report, might be from sales analysis report, anywhere really. How do you get all these figures that you used, right? Because sometimes it can even be from historical accounting records, or you might just take another company in the industries to benchmark your own and use it for CVP analysis. Look at this important note at the end. They said the accuracy of CVP analysis depends heavily on the reliability of cost classification. So how reliable is that your classification into fixed and variable costs, right? And then the validity of underlying assumptions. As I said, most of those assumptions are not very realistic. And then the quality of historical data and record keeping. So at the end of the day, you need data to get information. So how reliable is your data that you are using? So the limitations to asking the same thing or saying the same thing. So some of the limitations of CVP and break-even analysis that they hold unrealistic assumptions. They hold unrealistic assumptions about revenue, about costs, and then they simplify businesses that are very complex. So as I said, you are saying there is no inflation and things like that, but that's not always true, right? And then there are operational limitations and all of that, which is not taken into account by but it is not taken into account by CVP analysis. So okay, we're going to get into calculations real soon. But before that, ask me questions, please. Are you still with me?
Yes, ma. We're with
Yes,
you.
ma.
Okay, ask me questions.
There's no
Okay,
question for now.
you don't have questions. Okay, I can hear you.
No, I said there's no question for now.
Okay, okay, all
Um,
right.
ma, for those variable costs, fixed costs that we have been talking about, my
Yes.
problem with them is that I haven't gotten those examples of them. Like I'm not able to identify some of their examples, maybe because I've not gotten the real meaning of them. I don't know if you understand what I'm saying.
I understand.
Hello, ma.
Do you attend last week's classes? Can you hear me?
Yes, ma.
Attend last week's classes.
Is it Sunday?
Yes.
No, no,
And did you read the recording or the notes? Did you watch the recording or read the notes?
not at all, ma.
So most of those explanations are there.
Okay,
Talked
okay. All
about
right,
every
ma.
part.
Okay.
So you can just go over it. If you have any more questions, you can reach out to me.
All right, ma.
So
Thank you.
let's get into calculations. I'm going to send a document now to the group chat for it contains some questions. Okay. I've seen them. Have you seen the document?
Okay.
So if you have seen them, let's start. We're going to be starting with the question on the second page. Let me just start my whiteboard now.
Okay, the one that started with examination type questions.
Yes, yes, yes. But go to the second page. Alaji Ghazali.
Yakasi, baby. What is
Alaji Ghazali, the second question. Have you seen it?
Alaji Kasali? Did you say Kasali?
Yes, yes. The second page.
Yeah, I could see it now.
I don't
Okay,
see it.
the second page. Second page.
Second page.
Yes.
I'm on the second page. Is it Alaji Gaza plans to sell toy? Is that it?
Yes. Yes. Yes.
Okay.
Yes. Yes. That one. So can you see the
Okay,
white?
okay.
Can everybody see the whiteboard? Okay. So start. So okay, I need somebody. Can somebody volunteer to read for us, please?
Alaji Ghazali plans to sell toy rockets at the Kano International Trade Fair. He may purchase these rockets at 5 naira each, with the privilege of returning all unsold rockets. The boat rent at the fair is 2,000 naira payable in advance. The rockets will be sold at 9 naira each. Determine the number of rockets which must be sold to break even, as well as the number of rockets to be sold to yield a 20% operating margin on sales.
Okay. Thank you very much. Who is on my whiteboard? Who is helping me to write? Okay. So this question is on break-even points and target profits. Yes, it's a very good place to start. So let us first explain. Let's first take a question on break and see how well you understand that. Okay. Now, you may purchase this. We were told that want to determine break-even point, BEP, right? We're trying to determine break-even point. So we are told that BEP now is where total sales, pardon my writing, is equal to total cost. Okay.
Ma, sorry, we can't see what you're writing. Are you writing something?
Yes, I'm writing on the whiteboard. Can you see it?
No, ma.
I think you have
No,
to enter the Microsoft thing before you can see it.
I have to enter what?
You have to enter into the meeting back. You cannot see it from WhatsApp.
Okay. Oh, okay, that's the
I
issue.
thought I could see it too, but it's not possible.
Can you see it now?
No, man.
Yes,
He
I
wrote it. I can't see it on my side.
Okay, can anybody, is there anybody else that cannot see it?
Yes, we can see it from
I'm
here.
seeing whiteboarding in progress.
I can
That's what
see
I'm seeing on my
GEP is total sales is equals to total cost.
phone.
Okay,
Okay.
yeah, I'm going to stop sharing, then I'll start again. Stay in the meeting. Make sure you're in Microsoft Teams app.
Is writing whiteboarding in progress?
Yeah, now starting it again. Okay, can you see it now?
It's
No,
still
man.
same, man.
Hey, stop sharing.
Ah,
You still can you see it now?
no, man.
It's not the problem. Okay, somebody is sending a thumbs up that they can see it. I don't know. Let me try to load it another way. This one is going to take time. Can you still not see it? Or is it better now?
I can't still see it. My
Can't
still the
still
same
see
thing.
anything.
It's writing whiteboarding in progress.
It's not the problem. Okay, you know what? This is like the only way I can enjoy.
I'm shaking it to cut.
Is that what you can still see? Are you still seeing whiteboarding in progress?
Yes,
I
ma'am.
can see the whiteboard.
Okay. I'm going to write something on it now. Tell me if you still can't see anything. Can you see anything on it now?
No, ma.
Okay then. Um, this is not going to work at all.
Then the teller.
I can still see it.
You can still see it.
Yes.
Can you see what I wrote on it?
Yeah, I saw it for you pinned it.
I don't see it, ma.
Maybe can you write again?
I wrote something on it,
Shiro BEP.
I was seeing it before.
but now you can't see it again.
And maybe I will just have to disconnect and
Reconnect. Okay, disconnect and reconnect. Let's see whether it will work, and then we'll know that that's what the problem is.
I disconnected and reconnected. It's still the same thing.
Okay then. A situation where only one person is seeing. Yeah, sorry, my mic was muted. Can you hear me?
yes,
Yes, we
ma'am.
can hear you now.
Okay, can you see my screen?
Yes, ma'am.
Yes, ma'am.
So we're going to try and use Microsoft Word instead since whiteboard is not working. Since we all cannot see the whiteboard. So okay, let's go back to the question. So the first question is on BEP analysis, right? Can you see what I am typing?
Yes, ma'am.
Okay.
Please, can you zoom? Okay, don't worry.
Is this better?
Yes, ma'am.
Okay. Size. So you can see it's better. Okay, so Alaji Ghazali. So what did they ask us to do? They said we should determine the number of rockets which must be sold to break even. And we are told that at break even point, total sales or revenue is equal to total costs. Or you can say at BEP, total contribution is equal to total fixed cost. Are you following me? So,
Yes, ma'am.
so they said we should determine the number of rockets. Now, what we are looking for is BEP units, right? Units. Who copied? Which of you wrote down the formula for BEP units the other time?
I
Okay, so can you call it out for us?
fixed cost all over contribution per unit.
Okay, fixed costs all over contribution per. So what is our fixed cost here? Who can tell me what our fixed cost from the question here? We are told that the boot rent at the fair is 2,000 and payable in advance. Do you think that is a fixed cost?
Yes.
Okay.
Yes, ma'am. Yes, ma'am.
2,000.
So it is like that boot rent now or yes, it's basically rent. Something that he will pay whether he sells or not. He's paying it in advance. So 2,000 naira. So our BEP units is equal to 2,000 divided by. Now, what is our contribution per unit? How do you get contribution per unit? What is the formula? Did somebody write that down?
Did you say
Sales
per unit?
price. Sales
Yeah,
price minus cost price.
yeah, sales price, selling price in per unit minus cost price per unit. So what is your selling price per unit? So what's your selling price per
The selling price per unit is 9 naira each.
unit? Nine minus what is your cost price per unit? Cost price
5 naira each.
unit. So
Please, ma, I can't get that. I don't think I write down the formula for contribution per unit.
the contribution what but you wrote down the formula for contribution, right?
Yes, ma.
So contribution is your sales minus your um variable cost, right? Or sales minus cost basically, right? Sales minus variable
Yes, ma.
cost. I it means so your sales might be in total and it might be per unit. So in this case, we were given per unit. Jonathan, we are looking for per unit. You get so if it is in per unit, it is selling price. You can write this down. Contribution per unit is selling price per unit minus your variable cost per unit. Do you understand that? Are you with me?
Yes, ma. Please, ma. Contribution per unit, abi?
Yes, is equal to selling price per unit. It is all in the notes I will send to you, but you can write it down. Selling price per unit minus variable cost per unit.
Okay, ma.
So your selling price per unit from the question
Ma,
is nine.
can the variable cost per unit also be called cost price per unit?
Yeah, it can be called cost price per unit. Yes.
Ma,
Yes, yes, yes.
ma, did you
Can,
hear me?
yes, yes, I did. Can you hear me? I said yes. I'm asking you.
Okay, so
Can I hope you can all hear me. Can you all hear me?
Yes, ma.
Yes,
Okay.
ma.
So let's get back to it. So coming back to this, the answer is going to be 2000 divided by 4. So your answer would be 500.
500.
500 units.
Yes, we are looking for it now. That's the first one. So then I said, as well as the number of rockets that will be sold to yield. So here now we've looked for BEP. Now telling us again that we should do target profit, 20% percent operating margin on sales. Okay, so first let's look at it this way. Um, we don't know how many rockets he aims to sell, but we know that his selling price is 9 naira, and we want to find a profit. Sure. Okay. If he's selling 500 units, 500 units, what is the sales? Total sales. Total sales.
500 times.
Yes, 500
4 5.
times 9. 2 times 9.
That's 4,500.
Yes. Now, I want to now look for a target profit that is 20% of 20%.
Oh, 45.
So basically, what they are telling us here is that after doing total sales, they're just saying when we do total sales, or when we do sorry total contribution, total cost. should get 4,000, 20% of 4,500. What's 20% of 4,500?
900.
So they are basically saying we must get 900 after doing this. Do you
No, it's
understand?
1,000. 1,000.
Why is
20% of 4,500
it's 900?
is 900. Yes. So basically, what they're asking us to do now is, okay, we've already decided that you want to sell 500 units, right? But what if on those 500 units now, you want to make a profit of 900? How do you um, how many units are you going to sell? Two,
100?
second.
100? I cannot hear you. Ma, I think you're muted, Ma. We can't hear you.
Yeah, sorry about that. Can you hear me now?
Yes, ma'am.
Yes.
So there are two different questions entirely. Now we found out the first one. How many units should we sell to break even? How many units should we sell to make sure that our total sales will be equal to our total cost, right? We can now check this. Let's check if this is correct. If we are selling 500 units, how much is our selling price? 900, right? So let's see. I want to check. If you say you should check, 9 times 500 for 5, right? Then what is your variable cost? Your variable cost is 5 times 500. I'll give you 2,500. So
25.
so when you deduct this, you get what? Contribution now will be what?
2000.
So default 2,000. And when you deduct your profits from, I'm sorry, fixed cost, your fixed cost is 2,000, right?
Yes.
2,000, 2,000. So that will give you 0. So yeah,
0.
yes, since we are doing B. Now they're now saying that's for the first one. So the second part of the question now says, how many units should we sell if we want to make a 20% margin on sales? They're not telling us how many units we're selling. They're just saying how many units we will sell that when we check this again, when we do this same check, the profit we get will be equal to 20% of our sales. That's what they're asking. So this is going to be a lot of mathematics, but let's get into it and try. So if you wrote down the formula for target profits, the formula for CVP units is this. But for target profits,
That's required sales unit is equals to fixed cost plus target profits divided by contribution per unit
fixed cost plus target profits.
divided by contribution per unit.
Okay, so this is what we are looking for. So now, we know that fixed cost is 2,000, right?
Yes, ma'am.
Do we know our target profit? We just our target
No,
profit
ma'am.
percent of our margin, right?
Yes, ma'am.
So now that's where the problem comes in. So the problem now is we don't even know what our destiny is. So let's assume let our sales unit be X. Let me put this here. Those are sales. Let's sales units. That's sales units. X. So if our sales unit is X, that means our target profit is, oh, sorry, will be, what will our target profit be? It will be 20% of whatever that is, right?
Mm.
20% of X. Now it's not just whatever that is, it is 20% of 9 times whatever that is. Because what we are looking for is units, right? Are you with me? Now this is what they ask us to do. They said at the end of all our calculations, we should be able to say our profit will be, um, let's say if you what they're trying to say is if your total sales now, that means your selling price. You know that there is a difference between selling price and total sales. We have been given selling price, but we don't know what total sales is. Total sales is a function of both your selling price and the units you are selling. I hope you are following me. So
Yes, ma'am.
your total sales is 9x. That means your selling price times the total number you are selling. This x is what we are looking for, but this 9 is there. And they are not saying your target profit should be when you do 20% of your total sales. Do you understand?
Yes, ma'am.
Okay. Does anybody have any question? Should I go back to that or can we move forward? Should we solve it? Okay. I will take your silence as a no. So let's move forward. So target profit is 20% of 9x, or you can call it 0.2 times 9x. 0.2 times 9x. 0.2 times 9x is what? 0.2 times 9 is what?
1.8.
1.8. So your target profit is
1.8.
8x divided by, so all of this divided by your contribution per unit. It remains 4. Your contribution per unit is still 4. So this now will be, you can open, let's see, how are you opening your question? Okay, sorry, give me a second. This is your total system. So your x, yes, what we're looking for is x. X is equal to 2000 plus 1.8x over 4. So x now is equal to, or when you bring out, when you cross multiply, 4x will be equal to 2000. There is a lot of mathematics. I need you to understand there is a lot of mathematics in break-even analysis. 1.8x. So you are going to collect like terms. So 4x minus 8x is equal to 2000. 4 minus 1.8 is what?
2.2x.
2.2. So 2.2x equal to 2000. 2000 naira, and x is equal to 2000 divided by 2.2, which is 909 points, whatever. Let's just say approximately 909.
909.09.
Okay. Since is in units, but let's just leave it like that. Units. Now let us check. So before we now go into a deeper explanation, let's check. You sell 909.09 units. How much did you sell each one? 9 naira, right?
Yes, ma'am.
9 times 09 is what?
8181.
So 8181. This is now this
Point
one.
81.
Okay, 0.81. 81. Let's write everything. 81. So, sorry. This is your total sales. I hope you know that.
Yes, ma'am.
Now, what is your variable cost? Your variable cost is going to be 5 times 0909. 454545, right?
Yes, ma'am.
This is your variable. Now, so what will be your contribution? Contribution will be equal to this. So what's the answer?
3636.36.
Okay, 3636.36. Okay, now what will your profits now be? Your profits will be equal to 3636.36 cost, right? 2000.
Yes.
So yeah, so it's going to be 1636, right?
Yes, ma'am. 0.36.
1646. Okay, thank you. So this is our profit. Want to check whether this profit here, want to check if this profit here is equal to 20% of this sales here. So I need somebody. What is 20% of this? 20% of this is what? Of your total sales is what?
1636.362.
Are we correct?
Yes, ma'am.
So now ask questions.
Yes.
Ask the questions. Let me reduce this so that you can see everything together. Let's bring them to one. Okay. So nobody's asking me anything. Oh,
Ma, I have a question.
okay. What's your
Okay.
question?
According to, sorry, ma'am, I'm coming. That means we have to sell. That means we have to sell 909 units of rockets
Yes.
to be at to be at to be at break even.
No.
And
It means
um
you have to sell 500. Look at this. We did break even first. Break
okay,
even was
we need
yes.
to sell 500 units to be at break even.
Yes.
Then we now need to sell 909 units to yield 20% margin
Oh,
on sales.
exactly. Yes.
Okay.
So,
Okay.
does anybody else have a question? Or should we move to number two
Can you go over everything from the place where we broke even?
from the beginning?
No, not from the beginning. From after the break even, after we got our
500
profit.
units.
Yes.
Yes. Okay. So
Yes.
you understand how we got to when we broke even, right? Where we broke even.
Yes.
Okay. So the second one was a target profit question. We asked how much we have to sell to make a target profit, to make a profit that when we calculate our sales margin, or that is a 20% on sales. That's what they were asking us in the second one. So here we've already gotten 500. So there are two different units. How many rockets will Alaji sell that he will make a profit where when he does 20% on his sales, it will be equal to that profit? Now we don't know. So that means we are looking for two things. We are looking for target profit. We don't know. We are not giving target profit. We just know it is 20% of sales. But we also don't know what sales will be, right? We don't know what our total sales is. Since the only thing we have is our selling price. I think they already gave us total sales. We'll just do 20% of that, and that will be our target profit. But they did not give us sales. They gave us selling price. So we are looking for sales units, which is even that's our main target. That's our main question. We're looking for sales units. So which is why we use mathematics. We said let it be X, right? And then if our sales unit is X, remember I said your total sales is a function of your sales unit and your selling price. Total sales is equal to sales unit times selling price. We've been given selling price as 9. We don't know what our sales unit is. That is what X is. And your target profit is 20% of your total sales. So that's how we arrived at function number one. I'm sorry, function number in this equation here. This equation in the third line. Do you understand? Are you following me? That's how we arrived at this equation here. Are you with me?
Yes. Yes.
Okay. So
Yes, ma'am.
all we did was insert this formula or use this formula. This formula is basically what we use to derive this equation here. So all we did was, normal mathematics, cross multiply, it's like times. Or do you want me to teach you mathematics? so,
No, no, no.
so this formula is basically what we when we found X was even originally what they asked us in the question, the sales units. X was what they asked us to find. So finding X is basically finding our sales units, and that's what our answer is. But this one now was just to check. So to check it, we are checking whether this 909 to actually give us a profit that is equal to 20% of our total sales. And so we checked. We did our sales. This is our sales. Let me make this clearer. Let's make it clearer. So our sales, total sales is equal your contribution is total sales minus variable cost, which is this, and then our profit is contribution minus fixed cost, which we use to get at this. And this is 20% of this. And can we take a longer question? Are you with me? Is anybody here?
Yes, ma'am.
All right. Okay. So let us take a longer question now. This is a very, very short question, a kind of question that cannot even come out because it's too simple for you people. I know you're scholars. So we're going to take like this. Number two. Now let's take the question on the first page. Are we there?
Yes, ma'am.
Time Nigeria Limited manufacturers. So I thought that let me just write it down. Write it out. Can somebody read it? Read the question for us. Somebody should volunteer.
Time
Sunday
Nigeria
Nigeria
Limited.
Limited manufactures and sells a unique product, the selling price of which is 20 naira. The summarized profit and loss statement for last year is as follows. You have sales 800,000 naira, you have direct materials 120,000 naira, you have direct wages 160,000 naira, you have variable production overhead, you have 80,000 naira, you have fixed production overhead 100,000 naira, you have fixed administration overhead 75,000 naira, fixed selling and distribution overhead 60,000 naira. Then you have net profit, addition of which gives 595,000 naira. Difference between 800 and 595, 205. Then less provision for tax 40%, 82,000. Then net profit after tax 123,000. Required A. Calculate the break-even point for last year.
Okay.
Should I continue, ma?
You can stop there. You can stop there. Stop it. Thank you very much.
Yes,
Um,
ma'am.
okay. So now the, one of the most important things to do when you have a very long CVP question, like this looks like an exam type question actually. So one of the most important things to do when you have an exam question like this is to first sit down and think about all the variables that you will need when you are calculating. So you already know that when you are calculating break-even points, you need fixed cost, you need contribution per unit, you need contribution margin ratio, all those things. You first sit down and look at the question. Do I have them? Am I given all these things? Do I need to first calculate all these things by myself? So you should first sit down and do your workings. First sit down and try to bring out all these things. If you look at the question now, you can see that fixed cost is more than one. And what you need is the total fixed cost to be able to calculate. So you first have to bring that one out. You need your total variable cost because we have more than one variable cost here. You should bring them together. We don't know how many units we sold during the year. They did not tell us. But we were given some variables that you can use to get those ones. So you first bring out all these things before you can now sit down and say, okay, what is my this thing, um variable cost, all this before you can now start and say, okay, what is my break even point? What is my margin of safety and things like that. So let us start. Let's want to look for how many units. Were we told how many units we sold? I need your response, please. So were we told how many units we sold?
No, ma. No, ma.
Okay. So
They
how
only give us in naira.
yes, they gave us naira 800,000 naira. But did they tell us what our selling price is?
Did they
No.
tell
Question
us
now.
what?
Our selling price. Did they
Our
tell us
selling
our
price is 20 naira.
We just have
exactly? So if selling price is 20 naira and total sales was 800,000 naira, how many units did you sell?
That's 800,000 naira times 20 naira.
Times or divide?
Oh, our total sales. Okay, it's divided. Sorry.
So what
That's
would that
40,000.
exactly? So we sold 40,000 units.
Yes,
So
ma'am.
button down. Now what is our total variable cost? Our total variable cost. How many variable costs do we have there? We have direct material, direct wages, and variable production overhead. Those are our three variable costs. So we have to add everything together to know what our total variable cost is, right? So calculate
As
that.
360
60.
Okay.
plus 160 plus 80.
So that will give you
That's 360.
360,000. 60K. Now total fixed cost, uncle.
Fixed production overhead,
Yes.
fixed administrative overhead, and fixed selling and distribution overhead.
So that's 100 plus 75.
75 plus 60.
And what
That's
is that?
235.
35.
So 35. Okay. So now here we used to get our number of units. We use 40,000. So if we want to get, we were giving 20 naira, but they did not give us our variable cost per unit. They only gave us our selling price per unit, right? So we
Yes,
want to
ma'am.
find variable cost. How do you get variable cost per unit by yourself? If total variable cost was 360,000 and you produce 40,000 units, what is your variable cost per unit?
That's 360,000 divided by 40,000.
Yes.
I don't go.
And what is that?
9.
Yes. Nice. So 9 naira. And then what will be your contribution per unit? If your selling price per unit is 20
That's
and
11 naira.
it's 11 naira.
Hey, I'm lost too.
And one more thing, let's look for contribution to sales. Sales ratio. Contribution to sales ratio. The formula for this one is your contribution over sales times 100. Right? I'm sure somebody wrote that down the other time. It's 100. So what is the answer here? 11 over 20 times 100 is what?
55.
55.
55. So you can either leave it as just 11 over 20, which is 0.55, 55%. But please don't forget your percentage. So now,
Ma, please, what did you call the formula for contribution to sales ratio?
it's just contribution over sales times 100. Or you can just leave it as contribution over sales.
Okay, ma.
So it could either be contribution over sales or contribution per unit over sales per unit. So now we use contribution per unit over sales per unit. But then what if we
Yes,
want to
ma.
use total contribution over sales? Did I bring out our total contribution here? What's our total contribution?
You didn't bring out our total contribution.
Bring it out. Total contribution. Let's bring it out here. What's total contribution?
That's, I don't know, sales minus variable cost.
Yes. Sales minus variable costs, right? So what is it? So
Yes,
that is
ma. That's for
800,000.
800,000 minus 360,000. That's for 40,000.
So if you do for 40,000 now over 800,000, will it give you 0.55?
Yes, ma'am.
Exactly. So it will either be, you can either say total sales over total contribution, or you say selling price per unit. I'm sorry, contribution per unit over selling price per unit. Don't mix it up. I'm sorry about that. So can we move on?
I'm
Let's start.
lost.
Where are you lost? We've not started solving yet. What we are doing here is we are
Yes.
trying to bring out all the things that we need. Do you understand that we might need? So we have taken a look at our formula. We need to do, let's say for instance, now the first one said BEP for last year. Now, if they do not specify whether you should do break-even point sales or break-even point units, you can just take any one or do both. You can just decide to do both. Do you understand? Let's for us now we're going to do both. And I'm going to show you another way that you can derive it without you applying the formula twice. Now, before I get there, say for instance, 1 to 2 BEP units. The formula is fixed cost over contribution per unit. We are giving our fixed cost, but it was broken down into three different things. So we have to add everything together to have our total fixed cost. They did not give us our contribution per unit, so we had to find that one by ourselves. If we want to do it in naira, we need contribution margin ratio. They did not give us that one, so we had to find it by ourselves. All these things, they did not even give us our total variable cost as a whole. They broke it down, so we had to find it. They didn't tell us explicitly what our number of units sold was, 40,000 units. So we have to look for that. All these things, they are very important. So you look at your question, you look at how the structure of the question is, what they give you in your exam. Before you now sit down and bring out all the things you might need. You call it workings. Just bring out all those things before you start answering the question. Do you understand? So let us let's take a question now. The first one said, can you hear me please?
And
Yes,
not really clearly like that.
Uh, what's wrong? Can you hear me now? Is it better now?
Yes.
Okay. So we are calculating break-even point for last year. Let us calculate in units. BEP. What is our formula for BEP units? I'm going to be asking you. So what's the formula for BEP units?
Fixed costs
Fixed
all
cost
over
divided by
contribution per
contribution per
unit.
unit.
Fixed cost CP per unit. So that will give us what's our fixed cost? Our total fixed cost 235,000.
235,000
So 235,000
divided
divided
by
by.
11.
So what is our answer? What is the answer here?
21,363.
21.
21,363.664.
64.
So let's
0.64.
let's just approximate since it's units.
Okay.
Units, yes. So let's have this as units. Now let's do BEP sales. Sales now, it's what's the formula? Fixed costs divided by
Contribution to sales ratio. Okay.
so that's
Divided by contribution to sales ratio.
yes. So what is our fixed cost? 235,000
235.
divided by what's our contribution sales ratio? 0.55, right?
0.55, yes.
So what is the answer?
427,272.7 like that.
Yes.
no,
Seven.
273. Abi? Yeah.
Yes. So should we check? Let's check whether we are correct. First, you see that we have to apply two different formulas, but you can also just say, what did we get here? We got 21,364. If you multiply 21,364 by the selling price, what's the selling price?
20 naira.
Yeah, what will it give you?
427,280.
That it's got to be approximated that we did not get the exact figure, but I hope you can see it. So
Yes,
like that
ma'am.
that way for you to just get it. So let's check whether this is actually our break-even point. We sell, we sold this amount of units and we are selling this, right? We got this is
Yes,
our
ma'am.
sales. The sales is equal to 427,273. And then what's variable cost now? Variable cost,
Total variable cost or variable cost per unit.
total variable cost.
360,000.
360.
Oh, sorry, variable cost per unit. My bad.
9.
9 naira.
9 naira. So 9 times this number of units is what?
9 times
21,364.
192, 276.
2,276. So what will be your contribution?
The selling price minus
That's 239,997.
yes.
239,997.
No,
I'm going to have
234.
is it 239 or 234?
Okay,
234.
234,997.
234,997.
Yes.
so your profit now will be what? Two, two,
Profit to be
7
contribution
minus,
minus fixed cost.
yes, so minus 235,000. So what would that give you? Yeah,
3
Zero. Minus something.
yeah, it's minus 3.
minus 3
So this
years.
minus 3 is because of what we approximated.
Approximated, yes.
It's because of what it is supposed to be 0. Do you understand? So we are
Zero.
correct. This is
Mine is meant
the
to be
So the
zero, Abby.
profit is
yes, it is meant to be 0.
contribution minus fixed cost.
Yes. So the reason why we got minus 3 is because we approximate. You know, this was supposed to be 427,272 point something, and this one was supposed to be 20.
80.
So
Yeah.
that approximation was what happened that we had minus 3, but this is still an acceptable difference.
Ma, I have a question.
Please go ahead.
If we get to see this kind of question in the exam, is it advisable that we approximate or we just write the figure as it is gotten by the calculator?
You can approximate, but then have a consistent approximation. The reason I approximated, especially for units, is because you cannot really have points one.
Points in units, yes, ma'am.
So especially for units, it is advisable to approximate. But for figures, you can maybe have like for sales in naira, you can have like
Whole number.
yes, you can have it in maybe 2 decimal places or something. Do you understand? Please give
Yes,
me a
Okay,
ma'am.
ma.
okay. So let's continue. Now that's the first one. And then you don't necessarily have to this checks that were most important, and I want you to understand it very well.
Ma, you know, I'm not hearing you very well. It's breaking.
Oh my god. Can you hear me? Can you hear me
Yes, ma'am.
now? Okay. So the reason why we are doing all these checks is so that please, can you mute your mic, please? Please mute your mic. Okay, thank you. So the reason why we do all these checks is so that we see whether we are correct or not. It's not necessary for you to check in exam. In fact, you can just do it maybe in your rough sheet to be confident that you are right. Do you understand? You don't have to show the examiner that you are checking anything. They already have the answers. They know what it is supposed to be. Now, that's the A part. So B, what do you understand by the terms profit volume ratio and margin of safety? Illustrates using last year's results. Basically, I think we should use this question to illustrate our understanding of margin of safety and profit volume ratio. Profit volume ratio is the same thing as contribution to sales. No, sorry, profit volume ratio is profit over sales. You know, contribution to sales ratio is contribution over sales, right? Profit volume ratio is profit over
Ma,
sales. I
Please,
don't know.
sorry,
ma,
ma, it's
you are
breaking.
not that
We can't hear
audible.
you.
Hello?
We can hear you better now.
Okay, I'm coming. Let me try to join with another device and see. Let me join with another device. Can you hear me? Can you hear me?
Yes, ma.
Yes, ma, it's better now.
Okay, so I'm going to use this to share my screen. And can you still see my screen?
Yes, ma.
Yes.
Okay. Okay, so let's continue. Now, as I was saying, I said they asked us to now want to see they want to demonstrate our understanding of profit volume ratio and margin of safety, right? Margin of safety. Now, I said margin of safety is how safe you are from making a loss. Let's illustrate it now using using an example. When we, according to the question, how much profits before tax did we make?
205,000.
Yes, we made a profit of 205,000. And then from our this calculation, we saw that if we don't want to make any profit at all, and sorry, when we make this profit of 205,000, profit before tax of 205,000, we were selling 800,000 naira. That was our total sales. But then when we said, okay, let's test how much are we
Sorry,
going to,
ma. Sorry, ma. Sorry, ma.
yeah,
Ma, please, how did you get 205,000? I'm lost.
it is in the question. Net profits before tax. I asked the question. I said, from the question, how much profits did we make last year? Can you see it?
Yes, ma. Yes, ma.
Okay. So now the first thing they asked us to do was that, okay, yes, we made 205,000 last year, but what if we made zero profit and zero loss? How much sales would we have sold? So that was what we calculated in this first place, that we saw that, okay, if we sold, if our total sales was about 427,000, we would not have made a profit or a loss. Now, margin of safety is now saying, how safe are we? I'm going to call margin of
From
safety.
making a loss.
Yes, how safe are we from loss? So that means MOS sales. Now, just like BEP, we also have MOL sale. That's margin of safety sales and margin of safety unit.
Units.
Do you understand? So now
Yes,
let's
ma.
first. So for sales, if we sell 800,000 naira, I'm sorry, we are currently selling 800,000 naira, but if we sell 427 276, we'll break even. So what's the difference between,
273, ma.
oh sorry, 27, is it 273? Sorry.
Yes.
So this is what we are currently selling. But if we sell this, we'll break even. So how safe are we from that break even? How far away are we from making a loss? That's what we want to see. So basically what they are saying is that if our sales drop by this, what's the answer to this now?
372,727. 727.
So basically now what this means is that if our sales should drop by this amount, we are going to make a loss. Do you understand? That's what
Yes,
they're
ma.
saying. We should drop by more than this amount. So if we should just mistakenly sell like 380, we should sell less by less than by more than 370,000. Let's say our sales reduced by 308,000. We are definitely making a loss. That's
Okay,
what
ma.
yes.
Does
Please.
this margin of
Of
safety
sale.
sales
Yeah.
is the difference between the actual sales and our sales during break
Exactly.
even?
Exactly. Yes. So it's the
Okay,
formula
ma.
is budgeted sales minus break-even sales,
Okay, ma.
or
Thank you, ma.
actual sales minus break-even sales. That's the formula. Yes. So this is listen. So if you are looking for units now, what would that one be? Oh my God.
Budgeted units minus break-even units.
Unit.
How are you highlighting now? Units. So that would be how many units did we sell at normal sale was 40,000, right?
40,000 units. Yes, ma'am.
And then break-even sales was what? 21,364.
Oh, yes.
So what is your margin of safety here?
18,636.
Yes, 636. If you multiply 18,636 by 20, what's the answer?
372,720.
You see that it's very close to this, right? Because of approximation, that's what, but it's very close to it. So you can just to check, just to be sure that you are correct or you are doing the right thing. All this. Okay. So that's our second question. I don't know why this thing is not highlighting. Anyway, let's move on. So that's margin of safety. So I hope you understand. You get the logic. Margin of safety is very easy to calculate. Another thing they might even ask you for is the percentage. Percentage that is your margin of safety. So your percentage is going to be 18,636 divided by 40,000 times 100. Do this, please. So they might ask you that what percentage of your sales is margin of safety. So that should be about 47%, approximately 47.
46,046.5 now.
So let's just approximate for. So approximately 47% of your sales is your margin of safety. Do you understand? So that is a margin of safety. Now the third one. Yeah.
The
the profit volume ratio.
Yes.
Is it the same thing as?
Yes. In most cases, they are used interchangeably. Yes, they are the same. It is the same thing as your contribution margin ratio. Actually, they are usually PV ratio is usually used as the same thing.
It's the same thing. It's the same thing as this margin of safety ratio.
No, it's not the same thing of margin of safety. It is the same as CMR, contribution to sales ratio, CSR, sorry.
Okay.
Yeah, they're usually used interchangeably.
Okay.
Now,
thank you, ma'am.
Yeah, please go ahead.
I thought the percentage for margin of safety is margin of safety in naira divided by the budgeted.
Yeah, you can also use that. If you try, you can try that one too. You can try that one. You get the same answer. You still get 40. You can try it. Did you get the same thing?
The budgeted will be is it the 800?
Yes. So it's your margin of that's 372,727 divided by 800.
0.465.
Exactly. So when you're
46.5%.
Yes, you still get the same thing.
Approximately 47.
Yes.
Yes, 46.5.
So should we move to the next question now?
Yes, ma'am.
All right. So the next one said determine the number of units to sell in the current year to achieve an after-tax profit of 100,000. Very good. So now we have reached the point where they're asking for after-tax profits. After-tax profit. So go back to the question. Go back to the question now. In all that we have been talking about since all I've been explaining since, we have only reached profit before tax, right?
Yes, ma'am.
Profit before tax, very good. So now they are now asking us, what if we go further and we go to profit after tax? Like okay. So now from the question, we are told that tax is 40%. If you see, they deducted a 40%. So we are just going to assume that next year is going to remain 40%, right? So now what they are telling how many are we going to sell that after we pay that 40% tax, we still have 150,000? That's what the question is. So after we sell after we sell a particular number of that we are looking for, if we deduct 40% tax from the profit, we'll still have 150,000. That's what the question is asking. Do you understand? So let's try to do this. Now I want us to, the first thing you need to do is this. Your profit, what you need to do is profit before tax. What you need, the target, you know how to find target profits, right? We've done target profits. You know how to get target profits. So the thing is, the first, yes, can you hear me?
Yes, ma. Yes, ma.
Okay. So the first thing that you need to do when you are giving profit after tax is to convert it to profit before tax and then work towards that as your target profits. Convert to profit before tax. So you have a step there. You have steps. So you have steps here. So the first thing is to convert to profits before tax. And then second one is to work with profits before tax. Profit before tax as target profit. So let's illustrate it now and see. Now, how do you convert to profit before tax? You use a formula.
Yeah.
The formula is 1 minus tax. Tax. Yes, formula is actually much. 1 minus tax times profit before tax. Please, I need you to take note of all these formulas. So this is how you convert your profit after tax to profit before tax. Sorry. So you do 1 minus tax times profit after tax. So let us take these steps now and see. So let's first convert. What is our profit after tax?
150,000.
Okay, so we're going to be doing 1 minus 40% times 150,000. So what would that give you? What's the answer?
59,999.
58,500
90,000. 90,000.
minus 58,500.
Wait, I'm coming. Give me a second.
90,000.
I am so sorry. Sorry. This is not the formula. This profit after tax. Not really that. Profit after tax divided by 1 minus tax rate. Yes, sorry. This is it. So profit after tax divided by, so that will be 150,000 divided by
0.6.
0.6. So what's the answer? Sorry.
250,000.
Yes, 250,000. Thank you. So you can check it. What is 40% of 250,000?
100,000.
100,000. When you remove 100,000 from 250, what will it give you?
150.
Exactly. So you see that that's our profit after tax. So your profit before tax is 250,000 and your profit after tax is 150,000. So now we've gotten our profit before tax. So now we are working towards 250,000 as our target profit. Now let's go back to our normal formula. They said number of units. So target profit units is what?
Hi,
Target
ma. Hello,
profit.
ma.
Yes.
Okay.
That's sales
The
unit.
40%, is it just
Yeah.
going to be the 1
Fixed plus
divided by
target profit.
40, or
What do you say?
I said, is it going to be that 40%? Are we just going to do 1 minus the 40 divided by 100, Abby?
Yes. If you can press it on your calculator, or 40% is the same thing as 0.4. So you can just find
0.4.
yes 1 minus 0.4. Whatever it gives you, you use 150,000 to divide it. Or you
Okay, ma.
yes. Target profit.
Divided by contribution per unit.
Yes. Yeah, but I'm going to call it CP. So that would be what? What's your fixed cost? Your fixed cost from the question is 235,000,
To
right?
35,000, yes.
35,000 plus what's your target profit? 250,000. So
Ma,
that
our
is what.
target profit. Okay.
Stay in the class. So okay. So that's what divided by contribution per unit. What's our contribution per unit from our original listen? 11, right?
11.
Easily.
Yes.
Right? Calculated it. So you just come here, place 11 divided by 11. So what's the answer? The answer is going to
And
be
11 is from the work we have solved before, Abby.
yes. By 11. What's your answer?
44,090.9.
Okay. So you can just say 44 0
44,091.
091.
yes units. So if you sell this amount of units,
09. Okay.
you are going to get a profit. I mean, you are going to get a target profit of 250,000, and then when you deduct your tax of 40%, you'll be able to get 150,000 left. Is that clear?
Yes, ma.
Yes.
Okay.
Ma, I
So
have a question.
yeah, please go ahead.
Ma, is it that whenever we see this kind of question, that we have to
Yeah,
look for our profit before tax? Like, okay, if we have gotten our profit before tax, we will now use
yeah,
it as our target profit for the next thing
exactly,
to do.
exactly. Yes.
Okay, ma. Thank you, ma.
So now sometimes they might now confuse you. Look at D. They said calculate the sales revenue required to achieve a net profit before tax of 50. So now I don't know what like they are just putting that profit before tax there as if they are trying to because some people now will not look at it and then they will just start working. They might think it's profit after tax, but then make sure you look at it. So profit before tax, there we don't need to do any tax adjustments or anything. They've already given us our profit before tax targets. Do you understand?
Yes, ma.
So,
Now, it's just like that first one that we solved for Allergic Ghazali, where we were told that we should look for something that will be 20% of our sales revenue.
Oh, yes,
But
ma.
now, in this case, now what are they saying? They are saying that, okay, we should calculate the sales value required to achieve a net profit before tax of 15% of total revenue. Do we know what sales value is? No, we don't. We don't know what it is. So that is X. That's what we are looking for. X
Yes.
is equal to, and then now um let me see. They're looking for sales value, fixed cost, right?
Yes, ma.
Fixed
Fixed
cost
cost plus target profit.
plus target profit. What is our target profit? Target profit is going to
250,000.
no, it's not 250,000.
250.
15%.
That's 15%
Yes,
of,
that question entirely. 15%.
yes,
15% of 800.
20 naira
No, yes, 20 naira. Thank you very much.
times
120,000.
X
Yes. So 15% of 20
times
times
X.
X
That's 20X.
20x. So basically 20x times 15%. What's 20 times 15%?
3.
Ma, the 15% I thought is on our total sales.
Yes, total sales
3.
is X. Total sales is X. So
Okay.
20x.
So
Do we understand this like this now?
so the formula we are looking for, is it total sales?
Oh, wait. I get where your confusion is coming from now. What we are looking for is the sales value, not listen. We are looking for it in naira now, not in units. So the 20 has to be here also.
Okay.
Is that clear?
But if we are looking for it in units, we'll
Units,
use
yes,
the
just X.
normal
Yes,
question.
yes, that one will be just X. If we are using for it in units, it will be just X. But since we are looking for it in naira, now what we're looking for is in naira sales value, total sales value.
Might have another question.
Please go ahead.
If we, as long as we are looking for it in naira now, like
Yeah.
can we use are we still going to use contribution per unit or
No,
contribution to sales ratio?
we are going to use contribution to sales ratio.
Okay, ma'am.
We are going to use contribution to
Uh,
sales ratio 0.55. Yes, go ahead, please.
this 20s now, is it from the E that we got that 20% from?
No, 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 no. We've not gotten there. We've not gotten there. It's just
Then how do we
20.
get the
20
20?
is the selling price. We are giving in the question selling price. It is the selling
Okay,
price.
okay, okay.
So now we don't know number of units, but we know that each one costs 20 naira.
20,
Is that clear?
Yes, ma'am.
yes.
Okay. So, and then we know that the contribution margin ratio is 0.5.
0.55.
Yes. Hmm. Okay. I want to be sure that we're on the right track. Okay. So 20x is equal to what's our fixed cost? 235,000 plus 15% times 20 is what? 3x, right?
Yes, ma'am.
3x divided by 0.55. Hmm. Wait, wait a minute. Is it 0.55 or 0.55x now? 0.55.
We can't hear you.
Danny, Danny.
Ma, we can't hear you, ma'am.
Okay, sorry. I'm sorry about that. Give me a second. My network is having issues.
Hello. Hello. Hello.
I don't think our network is good.
Okay. Okay. Were you able to write out those solutions?
Yes.
Okay, because I'm even thinking maybe once you drop it on the
Okay,
group,
can
I
you hear?
will copy it.
Yes, ma'am.
Okay. So, what are we trying to do? We are doing the fourth one, yeah?
Yes,
Uh,
ma'am.
they said we should calculate the sales value required to achieve any profits before tax,
15%.
10% of total revenue. Okay. Now, okay. Okay, so now are we trying to increase? The first question you should ask yourself is, are you trying to increase? If you want to, because you want to increase revenue, you're trying to hit a target profit. So what you are going to do to hit that target profit is you can either increase revenue or this thing or reduce cost or whatever. So in this case, let's take it that I want to increase revenue, right?
Revenue.
Okay. I'm coming, give me a second. Okay, sorry. The target profit is equal to 15% of our total sales. We don't know what it is. We just know it's 15% of total sales.
Of 20x.
Total
Are we
revenue.
starting all over again?
Yes,
From that,
yes, yes. Let's take the question again. Sorry. Okay, so hmm, hmm. So what is our normal formula to get to hit profit? Our normal formula is contribution minus fixed cost is equal to profit, right? I'm trying to look for a more simplified approach now so that we don't have to go through that long route. So our normal distance to get profit is sales minus contribution minus fixed cost.
contribution minus fixed cost.
Exactly. Now, what is your total contribution here? Your total contribution is your contribution per unit times the number of units you have to sell, right? Which we don't know. Are you with me? Instead of going through sales and then variable cost, let's just go straight to contribution. Your contribution per unit, which we got here, was what? 11, right? So if you do 11 times the total number of units, which we don't know yet, that's going to be 11x. Do you understand? Are you with me?
Okay, so that S is representing the total
Number
number
of
per
units
unit.
that you have to sell to get this amount, to get
Ma, that means we are not following the sales units from the question. We are trying to bring another sales unit.
Yes, you have to, because you have to sell a different number of units if you want to. Since we are not changing selling price, we have to sell a different number of units if we want to get that target profit. So if
Oh,
we are
okay,
selling,
ma. Thank you.
we have to do a different thing now.
Okay,
Do you
ma.
understand? Okay. So
Yes, ma'am.
our contribution margin ratio, our contribution per unit is 11, and then the number of units we are selling is X because we don't know it. So when you subtract fixed cost from it, which is 235,000, right? What is it going to give us? It's going to give us 15%. 15% of total revenue. Total revenue is now what? The same thing we did earlier, 20x. So if you look at it, it's still even the same thing, right? Are you with me?
Yes, ma'am.
Okay. So I just wanted to bring it in a way that is easier for us to calculate and bring in subject of the formula and everything. So here you have 11x minus 235,000 is equal to 3x. Are you with me? So 11x
Yes, ma'am.
minus 3x is equal to 235,000.
That's 8x.
Yes, 8x is equal to 235,000. And x is what?
29,375.
29,375.
375. So basically, you're saying if you sell 29,375,000 units, right? Units, you are going to make a profit that is 15% of your total revenue. So let us check if we are correct.
May I have a question?
Please go ahead.
Ma, if we had used the one we started using before,
Yeah.
we're still going to get the same thing.
Should we test it too?
I mean, I
Ma,
already,
I
like
forgot
when we
to,
started, I already completed it.
You got 29,375, right?
Yes, ma'am.
So is that one longer or shorter?
I think that one is more understandable. I don't know.
Okay. Okay. So you can use whichever one you want to
All
use.
right, ma'am. Thank you, ma'am.
They're both correct. So I just felt like that one was already introducing too many concepts. Okay, get this, and this one was a little bit more straightforward and shorter. But if you feel like you understand that one better, you can use it. That's another beauty
And
in. Remember from our explanation, we said cost accounting is more like it allows more manipulations. It allows let
yes,
me
ma'am.
go this way. There is no exact formula that you have to use in cost accounting. So should we check whether we are correct or not?
Yes,
Yes, ma'am.
this 20x, I've forgotten, how did we bring about that 20x?
The 20 is your selling price from your question.
Okay.
Yes.
Now
So
I have
let
a
us,
question too.
please go ahead.
This second formula we used, why did we introduce the contribution per unit?
Because it is more straightforward. Sometimes instead of going through, I'll first find selling price per unit and then I'll get variable cost per unit. You can just say the easiest way to your profit is contribution minus fixed costs.
Yes, ma'am. Okay.
So that's why we use that.
All right, thank you, ma'am.
You're welcome. So let us check whether we are correct. So if you do 29,375 times the selling price 20, right? What's
that's
587,500.
7,500? Okay. Minus what's your fixed cost? What would be your variable cost here? 9 times 29,375. That would be 264, right? Am I right? 3.
264,375.
So what would be your contribution?
323,125.
Yeah.
225. So your profit now will be 323,125 minus 235,000. So what's that?
88,125.
88,125. So now I need you to do 15% of what was our sales? 587,500.
88,125.
So are we correct or not?
Okay.
So that is That's it. Okay, so our time is fast spent, and I'm not sure this laptop can go any further than this, really. So we're going to take, how many questions are left today? We have 3 more questions to solve under this very long umbrella. So I need you to attempt the remaining 3 questions.
Okay, ma.
So we are going to solve it tomorrow in tomorrow's class before we take the next topic.
Alright, ma.
So that is your assignment. Please, I need you to attempt it. You can, if you are fast enough, you can send it to me personally so that I'll go over it, and then we'll all go through the corrections tomorrow.
Alright, ma. Thank you, ma.
You're welcome. So do you have
Ma,
any
please, ma,
question?
please. Yes, ma.
Yes,
Ma,
yes.
please, can you show us that screen once again?
I will send the answer to you. I'll send the documents to you.
Okay, ma. Thank you, ma.
You're welcome.
Yes,
Okay,
ma.
so I'll stop sharing my screen. Thank you for coming,
Thank you.
and see you tomorrow.
Thank you.
Bye.
Thank you for teaching us, ma'am.
And mixing it.
Thank you, ma.